Hey, everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. But before we jump into rates and markets, I want to take just a moment. 1 Minute Monday is all about the market and how it affects your home buying, your refinancing strategy, and affordability. But while we're talking about numbers, there's a lot of men and women right now that are facing real uncertainty so that the rest of us can live pretty comfortably in our daily routines. So, to our military and our first responders, I want to thank you from the bottom of my heart, but I want to give a special thank you to the families behind you because without them, boy, it'd be a lot harder to do what it is you do for us every day. So, this has not gone unnoticed. Now, let's go ahead and talk about the markets. So each week, I attempt to take the complexities of what's going on in the market and deliver it in a way that you consume it best. So if you're somebody who just couldn't care less what a Fibonacci sequence is or how it drives markets and you just want to know what time it is, I got you. The next minute or so, it's just for you. Now, if you like to know how the clock works, we're going to go there too. And if you want to learn a little bit more about how to build the clock without a student loan bill, especially with war headlines, oil spikes, inflation data, and jobs week, well, this is probably your episode. All right, for my friends that just want to know what time it is, let's start with this. I've been doing this for over 20 years, and every time headlines get a little bit loud, rates tend to get a little bit emotional, and this time's no different. So last week, we actually saw that home prices are still holding up. Wholesale inflation, it came in hotter than expected. Mortgage bonds sold off on geopolitical headlines. The 10-year Treasury popped back above 4%, and mortgage bonds broke below a key resistance level. And oh, yeah, oil prices jumped. And as of this morning, the national average mortgage rates for Mortgage News Daily show the 30 year at about 6.12%, the 15 year at about 5.68. The 30 year FHA is also at 5.68, and the 30 year VA came in at 5.7. Now, remember, everybody, these are national averages. They include points and fees and a wide range of credit profiles. So, your personal scenario, it could look very different. It could be better or worse. But that's the temperature, at least as of this morning. And here's the important part: we've actually seen this movie before. If this conflict is short and oil prices normalize over the next, let's say, 10 or 15 days, well, history says that bonds tend to recover and rates settle right back down. Now, on the other hand, if oil stays elevated longer and inflation fears stick around, bond prices could stall and rates could hang higher for lower. That's what time it is. So now let's go ahead and start building the clock. On the housing side, prices are holding up a lot better than a whole lot of people expected. Case Shiller showed prices dipped about 0.3% month to month before seasonal adjustments. But after those adjustments, they actually rose by 0.4%. Year over year, national home prices, they're up 1.3%. And FHFA, which tracks conventional mortgages, they showed a 0.1% monthly gain and about 1.8% annual appreciation. Why? Well, because when rates eased earlier, buyers that were sitting on the sidelines because of those high rates, well, they came back in. And builders can't just flip a switch and create more inventory overnight. There's permits, labor, materials, and that stuff all takes time. So when demand improves and supply grows slowly, prices tend to stay fairly supported. And here's the longer piece. Fannie Mae's survey of over 150 economists actually projects a 15% cumulative appreciation over the next 5 years. So on a $500,000 home, that's roughly $75,000 in potential equity growth. And that's real wealth creation. And that number might be conservative compared to some others that are predicting 4.5% appreciation per year or better. Now, let's talk about inflation for a minute. The producer price index, or PPI, it rose 0.5% in January. Now, core PPI rose 0.8%, and both of those were hotter than expected. That matters because inflation directly affects investor appetite for treasuries and mortgage backed securities. Now, bond investors, they care about a real return, not just a yield. Here's what I mean by that. If a treasury pays 4% and we have 3% inflation, well, you're earning about a 1% real return. If inflation jumps to 4 or 5%, let alone the 8 plus that we saw after the pandemic, your real return shrinks or completely disappears. So investors, they demand higher yields to compensate for the higher risk. Now, higher yields, they mean lower bond prices, and lower bond prices mean higher mortgage rates. Now, layer war into that. When military conflict breaks out, oil usually spikes first, and oil affects the cost of transportation. Well, transportation affects the cost of goods. The cost of goods, well, that actually affects inflation expectations, and inflation expectations, they drive bond yields. We saw this in 2020 after the Soleimani assassination. Oil jumped, the 10-year moved up about 10 basis points. Well, within about 10 days, oil settled back down and yields followed directly. Now, we saw it again in 2023 after the October 7th attack. Oil jumped from the low 80s to around $90 a barrel. The 10-year spiked towards 5%, but within a couple weeks, both retreated. And more recently, in 2025, during the 12-day war, oil jumped, yields moved higher, and then guess what? Well, both settled back down once things stabilized. The initial reaction is always inflation fear. Now, here's where mortgage backed securities get even more sensitive than treasuries. MBS carry something called prepayment risk. When rates fall, homeowners refinance and bonds get paid off early. When inflation rises and rate volatility increases, investors can't predict how long those bonds are going to last or how refinance waves will actually distort that duration. That uncertainty makes mortgage backed securities less attractive during these inflation spikes. So, foreign investors, they often step back temporarily during geopolitical instability. Less demand means lower bond prices. Lower bond prices means higher mortgage rates. That's the mechanism. Now, the price of oil is going to affect inflation expectations. Inflation expectations are going to drive investors' behavior, and investors' behavior directly affects bond prices. Now, here's the fork in the road. If this conflict is short and oil prices normalize within, let's say, 10 or 15 days, inflation expectations will cool. Investors will return and bond prices will improve, and rates are going to likely settle right back down. Now, on the other side, if oil remains elevated and inflation data stays sticky, bond prices could stall and rates could remain elevated even longer. That's what we're watching so closely. Now, technically speaking, mortgage bonds broke back below that 100.38 level that we were really hoping they would close above and stay above on Friday, but they are still holding at their 25-day moving average, which has become our new floor of support. And the broader uptrend from December, it's still intact. Now, the 10-year, it moved back above 4%, but the downward trend from early February, well, it hasn't broken yet either. And this week is jobs week. So we've got ADP, jobless claims, and the big BLS report. So if job creation comes in softer than expected, that could support bond prices, leading to better rates. Now, if it surprises hot again, that could pressure bond prices, sending rates back in a not so pleasant direction. So for buyers that are waiting for both prices, home prices, and rates to fall at the same time, you've heard me say this before. History says that's a pretty dangerous strategy because when rates fall meaningfully, demand returns fast, driving home prices once again. So if you're considering refinancing, patience is still the best strategy. If you're within a half point to a full point of your current rate, or if the market is within a half point to a full point of your current rate, depending on your loan size, we should probably at least look at those numbers and see what might make sense. You might be surprised. Now, strategy almost always beats headlines. That's why we like to start a little bit early, because we can actually be ready if or when the right time actually comes. Now, as always, everybody, if you or somebody you care about is military, law enforcement, or a firefighter, we work really hard to build custom mortgage strategies designed to save our heroes as much money as possible. And a portion of what we do at the Shoemaker Loan Team, it goes back through the Home Foundation to support local heroes and local charities that care for them. Thanks so much for showing up each week, everybody, and a special thanks to those of you who share this with others that might benefit from the series. I'm Doug Shoemaker, and I'll see you next week.